you do discount. Okay, lecture demo time. So if you pull out, I know Rob does this on these sort of things on Excel. I much prefer drawing it up, as long as I brought along. I did. So, what are we doing? And what we're doing is looking at Bob and trying to figure out what's going on. Okay. Now, okay, there are a couple of things just to be, before we get started, there's a couple of things just to be aware of as we go through this sort of stuff. Now, the first is that there is a level of mechanical working through this that is important for this subject. Like, you are going to have to be able to crunch the numbers, work through it, and figure out how it all fits together. Look, in the workplace, if you're involved in these sort of things, that's, you know, actually sitting down with the calculator and doing those sort of things obviously doesn't happen. I mean, you're going to have systems in place where as long as you have the inputs, it's going to give you an output from it. So yes, you're not going to have to do this out in the workforce. However, it is useful to get an understanding of how the mechanics do work. Now, on top of that, it's important to just understand the economics of what's going on. Now, and I'll take a step out of what we're just doing right now, and that's actually one of the biggest issues for this subject. Not so much of an issue, although it is still, but not so much of an issue for the things that have been done up to date. But going forward, you've got to have a really good understanding of the economics of what you're dealing with. So looking at what the transaction is, because when we start getting into sale and leaseback arrangements for leases, when we start looking at foreign currency derivatives, figuring out actually what the economics of the transaction are actually, I would say, probably 75% of the battle. If you can understand what's actually happening, the accounting itself becomes really straightforward. But if you don't understand what's happening, trying to do the accounting is almost impossible, because that's when you start having to try to remember stuff and formula and just the way the journal entries look, and that's when mistakes happen. So if you can understand the economics, the actual transaction itself just flows out really naturally from it. So the idea with this sort of calculation, because we're coming up with the present value of a defined benefit obligation. So what we're trying to do, and I absolutely advocate, and I've been talking to some people during the drop-ins, and some of them were over asset impairment questions. Timelines are your friend here. Draw stuff up. It really makes a difference. So in this case, we've got Bob. Bob has been working at his current place of employment for 8 years. So I'm going to draw Bob. Look, in an exam, you don't have to draw little people if you don't want. If you do, feel free. But for me, it helps me. So Bob's here at time 8. He is entitled to 12 weeks of long service leave at time 15. So if he works for another 7 years, he can take 12 years of leave. However, there's another condition in his package, which is if he gets to time 12, he's not allowed to take leave at time 12, but what he is allowed to do is if he leaves the company after 12 years, he'll get paid out a proportion of his long service leave, because he has earned a certain amount and they're happy that he's worked enough that he can take it away with him. So at time 12, there is potentially going to be some sort of outflow at that point in time, and that's when the company is first obligated. Time 15 is when they're fully obligated, and obviously if he keeps working, then, you know, that number will grow. So time 12 for us is the critical one. Time 12 is the time when the company has an obligation. So what we need to do is to figure out how much he's going to get paid at that point in time, because how much leave he gets at that point in time, or how much leave payout he gets, is going to be based on his salary at that point. So we need to know what his salary is. We then also need to know, how much, or how many weeks he gets, and that's easy because that's given in the information. We get told he takes 12 weeks, so that's not a hard piece of information to get. We also need to know at this point in time how much leave he's earned. Now what this number is at time 8, he's worked 8 of 15 years. So he's worked just over 50% of the time, 50% of getting 100% of his leave. Because if you imagine when he gets to time 15, and we got Bob sitting there at this point, he's got 100% of his leave, he gets his full 12 weeks. However, he's only worked 8 years, so he'd get, 6.5 weeks thereabout of his leave. So we need to know at time 12, we need to know how much he gets paid, how many weeks he gets, and then figure out how much of that he's actually earned. So to calculate all of that, the first thing we do in this case is get his projected salary. Now, some questions you may just get told, they expect his salary to be X. In this case, we've said his current salary is $83,000. His salary is expected to grow at 6% per annum. That should be a pretty easy calculation, and you end up with $104,936. We then need to figure out the accumulated long service leave benefit. And so if you want to think about it this way, it's the defined benefit obligation. So at this point in time, of that $104,000, this number here, the 12 on 52, is the weeks. Look, if you get told the number in weeks, just use 52 as the denominator. If you get told the number in months, use 12. We're not too worried. I mean, if you wanted to use, figure it out exactly, you can do that as well, but we're happy if you use 52. This number here is the amount that he's earned. And this is based on, even though we're looking at time 12, this is based on where Bob is right now. Bob's at time 8. You use 8 years over the full 15. Even if it's prorated, you don't do that as 12. Because even at time 12, he hasn't earned 100%. Time 15 is the 100% amount. So 104,000 times 8 on 15 times 12 on 52 gives you close to $13,000 as his defined benefit obligation. Now, so that gets us 12,915. So we're at this point. Now, as I'm sure you can all figure out, the problem with that is 12,915 is in future money. We need to bring that back to today. So we present value that. And in this case, we just get told the discount rate is 7%. It's just been given to you straight up. That may not be such an easy thing in an exam. Or even in the tutorial questions, and the standard actually does give you some information about how to choose a discount rate. But regardless, we've been given 7%. Just do a normal present value calculation, and you end up with $9,853. So the present value, and we're not quite finished, but at this point, if you think about it, the present value of that defined benefit obligation is $9,853. Now, there is one thing missing. And given that I've given you the sheet, it's not exactly going to be a surprise. But the thing that is missing is for that to work out, for that 9,853 to be the number that we want, but there has to be 100% certainty that Bob is going to be at that company in 4 years' time. Can you ever say that there's 100% certainty that someone is going to be at a company in 4 years' time? Can you even say with 100% certainty that a person is going to be there in 1 week's time? No. You could be hit by the bus. Well, okay, no one's going to be hit by a bus tonight, but obviously things can happen. So we have to then take that number and weight it by the proportion, or by the likelihood that he's still going to be in employment at that company in 4 years' time. Because if he's not there, if he leaves any time between time 8 and time 12, the obligation, what the company has to pay out is 0. If he leaves at time 11 and 11 months, he walks away with nothing. So what we need to figure out is what is the likelihood that he will walk away with nothing. And luckily, we don't actually have to figure out the likelihood. We just have to deal with the number that we get given, because that's not something we want you to figure out. In this case, we just get told that there is a 60% probability that he is going to be there in 4 years' time. So we take that 9,853, we times it by 60%, gives you 5,912. And if you actually want to think about it, the actual calculation would be this plus 0 times 40% gives you 0. Add those two together, gives you 5,912, because there's a 40% chance that he will leave before 12 years, which means there is a 40% chance that he's going to leave with nothing. Add those two together, you get 5,912. Just from the information that we've been provided, the opening balance was $2,000. We're looking for the change in that balance. That means the liability has gone up by 3,912. Without further information, we debit the expense, 3,912, and we credit the liability, 3,912. And that's dealt with the long service leave calculation. There is something else I just want to add to that. But before we go on, I mean, are there any questions about that before we move on? Yes?
How do you get the 60% figure?
Actuaries. Yeah, that's not something you're going to have to come up with, but that's where you have actuaries figuring out probabilities of what's going to happen and the likelihood of these sort of things. I mean, potentially for smaller businesses, maybe they don't want to consult an actuary, maybe they just come up with a ballpark figure, I don't know. But I mean, definitely for bigger companies with large workforces, you're going to need someone that can crunch those numbers, because, I mean, that can obviously make a difference. Like you change that from 60% to 50%, you know, for 100, you know, and you change it by 10% and you've got a workforce of 100,000 people, that could be a material difference. So yeah, you're going to have someone that hopefully knows what they're doing, coming up with those numbers. But yeah, so that's all good. Sweet. Everyone else all good? Not all good? Cool, everyone's all right. All right, at least I hope so. Now, the things I just want to talk to you about really quickly is assumptions. Assumptions are really big in this. And it's actually where, as I think I was saying before, professional judgment, professional assumptions are a really, really important issue here. So if we look through the numbers that we've been given, 83,119, that is a given number. We know that with certainty. That's what he's getting paid. However, the 6% growth rate, that's a made up number. Okay, made up is probably too strong a word. That is an estimate. Could that estimate be 5%? Could it be 7%? Could it be 2%? I don't know, it could be. But that's management judgment that's going in there. The 4 is given. We know that that's 12 years, so we know there's nothing that can be done there. 8 on 15, 12 on 52, those are given numbers. So there's no assumptions, nothing gets done with them. Present value, that 7% is an assumption. So the discount rate is often, and the discount rate is often where a lot of play can happen, because, you know, how can you argue if you say it's 10%, then you've got an auditor to come in and say, well, we don't believe it's 10%, but how do they really support, like how can they argue what management's doing? So I mean, it's a really difficult thing for auditors to come and say, we don't believe this should be 10%. Like, look, if you put it at 25%, I think they'll have a problem, but 8%, 10%, 12%, it's pretty hard to change those sort of numbers and not agree with what management's doing. I'm sure it's. And 60%, again, that's an estimate. Hopefully you've got, you know, qualified and independent actuaries dealing with this sort of stuff and people that are well educated and know what they're doing. But again, 60%, 55%, 65%, there is room for maneuver with those numbers. So again, just be mindful that when you see, and this holds for any accounting number pretty much, even cash. I was actually really surprised when I was over in London. I always thought cash flow, and we'll talk about cash flows at the end of the semester, I always thought cash flow was a completely objective number. It isn't. Companies estimate cash flow, which I was really surprised by, because I thought you could say cash, it's not, it's nothing like that. They actually don't keep as good a track as what I thought they do of what their cash flows are, and they actually extrapolate out what their cash flows are going to be. So anyway, this number, even though, and this is a more philosophical thing, and I certainly came across this when we were traveling around Europe, and for a lot of the hotels and a lot of the accommodation we were using a mixture of Expedia and Airbnb. And the thing is, yeah, you read the comments and the reviews and the qualitative stuff, but one of the big ways that you figure out where you want to stay is look at the number out of 5 that the reviewers give them. Because somehow a number seems to be much more objective than people's review comments. I don't know why that is. When you see an accounting number, just because it's a number, and because it's not a round number, doesn't mean it's completely and absolutely true. There is a lot of estimates that go into these. Doesn't mean it's wrong. It just means that you've got to be critical when you look at these numbers and understand how they're being created. So it's just something to be wary of. And that's if you're on, whether it's on the audit side, looking at the numbers, whether it's on the preparation side, whether it's on the analyst side and actually you're looking at financials. Yes?
In the last part, you're saying that there was this leave expenses 2009. Well, I think I need the first part because I came up late. But what is the difference between that one and the number that we found before? That is 5,900.
So why is that?
We find out that the 60% probability that
Hang on.
the employee is going to be
So
5,000. Yeah.
why is that number? Like, why are we multiplying?
I understand that. I mean, why we are recording less.
Why are we recording that? Yeah, that is a good point. Why we're recording less is because what we've just calculated is the level of the liability. So we've calculated all of that, and at this point in time, so the balance sheet snapshot point of view, we've gone, that level is 5,912. Last year's level was 2,000, so we're just showing that change.
The increase.
Yeah.
Accumulating.
Yep, exactly.